This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril Hong in Singapore. The top stories this hour. Asian markets set for a muted open after a solid economic reading drove U.S. stocks to a fresh high. Traders on watch for key inflation data that could impact the pace of Fed rate cuts. Fed Governor Lisa Cook sues to block President Trump from attempting to remove her from the central bank. Plus, Alibaba, set to report earnings later, focuses on the returns on its aggressive AI investments and the toll the hyper-competition in food delivery is taking.
Take a look at how we're setting up for the Asia markets. We saw some sideways trading in the last few sessions, of course, headed towards all of that economic data out today, including industrial production out of South Korea, surprising slightly to the upside. Month-on-month growth of 0.3%. The estimate was 4.2% growth. But, of course, we'll continue to watch the drag when it comes to U.S. tariffs on the auto sector. We do have industrial production numbers out of Japan as well this hour, not to mention Tokyo inflation numbers. So plenty for markets to digest as Nikkei futures hold steady. We had seen some strength for the Japanese yen in the overnight session against the U.S. dollar. We're holding at that 147 level against the greenback. Take a look at how U.S. futures are trading because fresh record highs. We're talking about the S&P 500 surpassing that 6,500 level. All of this, of course, coming at a time when we're seeing also GDP numbers surprise to the upside on the second quarter, coming in slightly higher than initial estimates. All of that having an impact on the bond space as well. Short data Treasury yields higher in the regular session over in the United States. All of this, as we heard from the IMF's Gopinath, warned about how fragile the bond market in the U.S. and globally was. She also talked about central bank independence. Take a listen.
Everybody agrees that central bank independence is critical, monetary policy independence is critical. So if we are not seeing much market reaction, it must be that people think that, well, that independence is still intact.
Fed Governor Lisa Cook's lawyers are suggesting a clerical error may be behind a mortgage dispute, which led to President Trump's attempt to oust her. She warns the move could cause irreparable economic harm. For more, let's bring in our chief U.S. economist, Anna Wong, in Washington. So, Anna, good to see you. We are seeing Lisa Cook pushing back, fighting back against Trump's moves. But what is your sense of how big a damage this could actually deal to the U.S. economy?
Yes, it depends on whether the Trump administration can provide clear evidence that and establish that the reason for Lisa Cook's firing is indeed for cause. And I think the perception here is as important as what's really going on. I think and what's happening is that the perception is that this move is motivated by the fact that the Fed has not cut interest rate yet. And so the next step we'll be looking at is whether Lisa Cook, in the hearing tomorrow, will be able to get a temporary injunction to stay the Trump decision so that she could still participate in the upcoming September FOMC meeting.
One of the contenders to become the next Fed chief, Christopher Waller, the Fed governor, continues to advocate for cutting rates, potentially in the next 3 to 6 months.
Yes, and we have seen that Waller had advocated for a rate cut even in the last meeting, but he did say that he does not see a 50 bips cut in September as necessary to catch up to the Fed not cutting in July. And I think the data still matters in the next couple of months and weeks. We still have the Fed's preferred inflation gauge tomorrow, and we're expecting that to show inflation has picked up in July, and that the 3-month annualized average of core PCE inflation has accelerated to 3% compared to the 2.6% reading from last month. And this is the measure that Waller himself had mentioned that he pays attention to. And another data point is, of course, next Friday's non-farm payrolls report. And I think the market is really hanging on to the data next Friday. And our preliminary forecast is that it will show non-farm payrolls have increased and improved in August, and that the unemployment rate would be stable. Also not adding to the case of a September rate cut.
And we also had those GDP numbers for the second quarter. That was revised upwards. I mean, is this an economy, as things stand, one that needs aggressive cuts? It doesn't seem like the case.
I think the most interesting piece in the second quarter GDP is the release of the the gross domestic income, which reveals that corporate profits has grown very briskly in the second quarter. And in fact, profit margin were as elevated as the first quarter and continued to be higher than the pre-pandemic level. And that suggests to me that some firms might be opportunistically passing through the tariffs, and some other firms probably have a lot more room to absorb the tariff cost than to pass it through to the consumers, given the really rich and a thick buffer in the profit margin. And I think that it also suggests that the labor market might not be as terrible as the non-farm payroll suggested last time if firms are seeing such rosy margins. And I think the broad consensus from the second quarter earnings is that firms seems to be doing better than everybody thought they would be.
Does that mean that households are also insulated from the pain so far, and how long will this last?
Well, this is the reason why it would be quite risky for the Fed to cut rates. So if they were backward looking, the data we have in the past 4 months is that inflation is not there. Tariff pass-through has been modest, whereas the job market has deteriorated. But if the Fed was forecast dependent, I think the conclusion there is that the worst seems to be over. A lot of economic data indicate that momentum is picking up in both the labor market and economic activity. And I think that if the Fed were to cut, we might see a brisker pace of pass-through because financial conditions will for sure be much looser, and household will have more nominal income from the wealth effect of the equity market.
So we wait to see these inflation numbers. Anna, great to have your insights. Chief U.S. economist Anna Wong in Washington. Let's see how this is all playing out in markets, bringing in Bloomberg MLI strategist Mark Cranfield. So S&P 500, yet another record. I've lost count how many we've seen this year. But what do you see in terms of the breadth, and does that inform whether this has legs?
The breadth is not compelling, but I don't think anyone's going to bet against it for now. It's an interesting situation because we're going into September, which historically is one of the worst months of the year for US equities. And yet, who is going to stand in the way of this? You have an economy doing much better than expected, as Anna was just describing. American companies' profitability is very good. And we quite possibly are going to have a Federal Reserve interest rate cut, which the economy doesn't appear to need, but we're probably going to have it anyway. And as Fed's Waller was saying earlier, there could be further cuts to come in this series. So you put that in front of equity investors, and there's really very little reason for them to hold back for now, just to continue going with this momentum, which is suggesting that 6,500 is just a stopping point on the way maybe towards 7,000 or something like that. It really would be a very brave person to aggressively go against this US stock market rally.
And we're seeing, of course, the impact when it comes to the bond space as well. But take a listen first what the IMF's Gopinath had to say about the fragile state of the global bond space.
The reason we've seen resilience is because we haven't had a financial crisis, despite the pandemic, despite wars, despite geoeconomic fragmentation, despite Fed rates going up very sharply. We've not had a financial crisis. That doesn't mean that that will never happen. We have very high levels of debt around the world. I think bond markets are in a fragile place. You have valuations in equity markets that are sky high. So I would say tread carefully, because if you do have a financial crisis, we know the scarring that comes from that is long lasting.
How these dynamics of debt and also public finances factor into the broader monetary path diverging around the world?
Well, this is really a big part of what's behind steepening of yield curves around the world, really, especially among the G10 countries. So what's been happening over the past few years, particularly since the COVID pandemic, is that you have fiscal policy on one side, monetary policy from central banks on the other side, and the two are just converging with the fiscal side really taking over so much of the momentum from the central bank side. Now, the problem for investors is that typically central bank messaging and policy is relatively clear to understand. It's fairly transparent. What comes from the government side is not necessarily so. It could be driven by politics, and that is what is upsetting investors. That's why they're asking for a bigger premium to own long-term bonds. That's why we're getting steeper curves, and there's no particular sign that is going to slow down for the time being, because if fiscal deficits are getting wider, if there's no sign that they're going to rein that in clearly, even though you would think at a time when the economies are doing extremely well, particularly the United States, that would be an ideal time for them to trim spending, get the deficit back under control, but there's no clear sign that that is going to happen. So in the meantime, investors will make their own decisions. They will decide, it's fine, we don't mind the short end of the curve, but we don't particularly like the long bonds, 30 years, that kind of thing. And that is reflected in steep yield curves.
We also see in Japan no particular effort to trim the deficit. We had that 2-year sale, that bond auction was quite bad just a day ago. I mean, are we looking at a live BOJ meeting for October?
Yes, that seems to be what's going on here. So we had Junko Nakagawa speaking yesterday. She's a fairly well-known dovish person within the BOJ, and yet her comments were seen as being neutral to slightly hawkish. What she appeared to suggest was that the Tankan report on the 1st of October is very important for the data. Providing we get a reasonable Tankan, it looks as though she would support a rate hike in October. There's still a long way to go. They've got a September meeting as well, but that will probably be used to set up the decision for October. So all things being equal, which if they ever are, it looks like the Bank of Japan is on the path to a 25 basis point hike in October, and there's plenty of time to prepare the markets for that.
Is this also an understanding? Is there also an understanding that perhaps the impacts from the uncertainty coming from the U.S. tariffs have already been felt? Has all of that been factored in by all of these central banks?
I think people generally are coming to the conclusion that the world has had a fair bit of time to absorb that, to get used to the idea, to price it in. There could still be some shocks along the way. We saw a recent shock with India suddenly being hit with 50% tariffs. Doesn't mean to say that somebody else won't be. But in general, I think investors have had several months to get used to that, to plan for it, to see how it's being embedded into the economy and to what companies are doing. So we're coming back to the more fundamentals approaches. Our economy is still growing, our companies still making money, is central bank policy supportive for financial assets? Most of those things suggest yes, that the world is in a reasonable place, even with the tariff situation. And central banks, mostly, apart from Japan possibly, are doing what they can to support growth and stabilize markets.
Tough time for central bankers, Mark. Thank you for weighing in on all of that. Great to have you in the studio. Bloomberg and Life strategist Mark Cranfield. And stay tuned for more commentary on policy, rates in the region. Philippine Central Bank Governor Elinor joins Bloomberg Television to debrief Thursday's policy decision. That's coming up in the China Show at the Times on your screens. This is Bloomberg.
The European Union has adopted draft regulations to remove all tariffs on U.S. industrial goods. It comes after the bloc struck a political trade agreement with Washington last month. Bloomberg senior editor Derek Wallbank joins us now from San Francisco. Derek, does this mean that the U.S. is also going to drop the tariffs on the EU?
Well, Shery, exactly. What this means is that the U.S. and the European Union had struck a deal that was a little bit of a step-in kind of deal. There was a top-line agreement, but it included the promise of future actions. And so this is a step towards those actions being realized. That's a really important thing here because in a lot of these conversations with some of the partners, we've had some hurdles as after the deals have gotten inked and we've had some, some difficulties, and was everybody doing exactly what they wanted to, and requests to get into to further escalate. This is a sign to me that the de-escalation between the United States and the European Union is definitely on track, that we should expect that to continue to stay on track. Not that there won't be hurdles in the future to come, not that there might not be disagreements, but for now we appear to be as on track with that de-escalation as I think many in the markets in both the U.S. and Europe had hoped.
We're also seeing the ending of the de minimis exemption. Aside from how this is impacting global trade, global shipping, what are we seeing already on small businesses, consumers in the U.S.?
Well, I think, Avril, it's a great question. De minimis. The de minimis ending is certainly on track. There appears to be no signs that the United States will reverse course at the last measure. Now, what this has meant has been an interruption for some shipping companies who have said this is a little too complicated. We don't quite understand what's happening here. We're going to pause shipments to the United States, and that has had certainly a complicating factor. Going into some of the escalatory phases that the U.S. was looking at, there had been some warehouse stock-ups ahead of time. While that may not be specifically de minimis related, it certainly will have an effect at blunting some of the immediate sort of economic complications you might get out of this. But one of the things that I have seen, and I've talked with a number of small business owners in Asia who are looking at the United States as a market. One in Bangkok told me she simply couldn't continue to keep the United States as a client destination area. It was just too much hassle, too much uncertainty, additional costs making products uncompetitive, and just decided to jettison it. Another one I saw in Japan has said, look, we it's not that we're done, but we just have to pause some things for now, because if you're confused as a consumer, we're confused as a seller, and we're not really sure what the plan is from here, and we haven't gotten all of the guidance that we want. Now, Commerce, the Customs and Border Protection have issued guidance on how this is supposed to work. We'll see if that clears the situation up for others. But you certainly have, I think, among small businesses that can't deal with the compliance costs, some of a pullback as it affects the United States. And that just simply has the effect of saying that a lot of businesses in Asia are saying our market, as we're targeting, can't include the U.S. That sort of pullout of the U.S. as an economic market for that has profound potential consequences going forward, because certainly the U.S. likes to see itself at the center of international commerce, not least of which with things like the dollar, that the more that the United States pulls itself out from those, the more that you can expect to see an increase in knock-on effects.
Derek, thank you. Bloomberg's Derek Wallbank for us. Now, Chinese President Xi Jinping's closest international allies, including the leaders of Russia and India, are gathering in Tianjin this weekend for China's biggest diplomatic event of the year. The Shanghai Cooperation Organization Leaders Summit will be followed next week by a rare military parade in Beijing. Our chief North Asia correspondent, Stephen Engel, joins us from the Chinese capital. Steve, what are we watching out for from the SCO?
Well, this SCO is probably more intriguing than past gatherings. The last one was in Kazan, Russia, back in October. This one, though, is being held obviously here in China, with Xi Jinping being the host. So they're going to have the full contingency of the 10 members, plus a number of different observers and participants that make up a large portion, about half of the world's population, as well as energy dominant countries and regions. So that's why we're going to be looking at potential deals in the energy space. But it's the geopolitics that is probably the most intriguing. No doubt Xi Jinping and Vladimir Putin, who will be here for both the SCO in Tianjin and the parade next Wednesday in Beijing, they will likely build upon their no limits partnership. But the real interesting dynamic for me will be the Modi and Xi, India and China, the rapprochement, the détente that is happening in the last few months, really, ever since we got that letter within the last 24 hours or so, details of that letter that was delivered by Xi Jinping to New Delhi and top officials there, offering the Indians some sort of opening for détente and repairing of a relationship at a time when, of course, the winds of protectionism were starting to rise out of the Trump administration in the United States. And that is a sharp contrast to what past administrations have tried to do and build this relationship with India as a counterweight to China. Now we have Wang Yi, the foreign minister, just coming back from what they claim to be a very successful meeting in New Delhi with the Indian officials. And now Modi is making his first trip to China in 7 years. He will be meeting, no doubt, with Xi Jinping. He'll no doubt be meeting with Vladimir Putin. Other participants, as you rightfully said, Xi Jinping gathering together a lot of his international allies, including the heads of Iran, Turkey, Indonesia, Malaysia, among others that are part of this SCO. So it'll be very interesting to see what kind of final statement. Let's face it, the SCO in years past, over 24 years of existence, when push came to shove at the end of the gatherings, when they want to have a joint statement, there hasn't necessarily been a coalition of cohesive statements coming from the SCO. Now it will be looking for that final statement on Monday, whether they can have a cohesive statement that India is also on board fully with.
Yeah, the Trump administration really looming large in this gathering, right? How significant is it when it comes to President Xi Jinping's goal of sort of remaking the global world order led by the U.S.? We have seen, of course, initiatives like BRICS also gaining momentum.
Well, no doubt the Trump administration has been angered by what they perceive to be India's profiteering. Those are the words of Treasury Secretary Scott Bessent, by buying cheaper sanctioned Russian crude and then reprocessing it at the refineries and selling it onto the global market. That has irked, obviously, Donald Trump's administration. They have slapped an additional 25% tariff on top of another, reciprocal tariff of 25%, so 50%, which probably took New Delhi by surprise. So this rapprochement that is going on right now between India and New Delhi is likely a byproduct of that. I just want to bring up a quote, though, really quickly before I hand it back to you. This is from Ashley Tellis, Senior Fellow of Carnegie Endowment for International Peace and a former U.S. diplomat in New Delhi, essentially saying Trump indeed is the great peacemaker. He deserves all the credit for stimulating the incipient rapprochement between Delhi and Beijing. He has single-handedly pulled this off by treating India as an enemy. I'll leave it there.
Our Chief North Asia correspondent Stephen Engel, they're joining us from Beijing on the latest on that changing dynamic in global geopolitics. We have more ahead on the Asia trade. This is Bloomberg. Oil slightly lower after gaining in the New York session. Prospects of a peace deal between Russia and Ukraine waning. The German chancellor saying that the Ukrainian president and Russia's Vladimir Putin, they won't be meeting anytime soon. This is Bloomberg. We have breaking news out of Japan. We are getting the jobless rate coming in at 2.3% for the month of July, coming in slightly below expectations, and also the rate falling from the previous month. The job to applicant ratio at 122, which is slightly below economists' estimates, but at the same level of 122 jobs available per 100 applicants as the previous month. What we were following is the inflation picture because we have those numbers for Tokyo, and of course that gives us an indication of national prices later on. Year-on-year growth of 2.6%, which is a slight deceleration for the month of August from the previous year. When it comes to the core inflation numbers, it's also a deceleration from the previous month of growth of 2.5%. Of course, we have seen some subsidies in Japan trimming the pace of inflation, but we continue to see food and wage costs firming in Japan, so we'll continue to watch the trajectory for the Bank of Japan here on out. The Japanese yen holding at that 146 level against the dollar. We're also following geopolitics here in Japan. India's Prime Minister Narendra Modi is set to visit Japan today ahead of a leader summit in Beijing this weekend. Bloomberg's Sakura Murakami is with us. And Sakura, we're expecting Prime Minister Modi to speak to Ishiba as well. What can we expect from those conversations?
So I think the main thing to expect here is a lot of deals, a lot of economic security related deals. So the main thing that we're hearing, especially that's been reported in the media, is a $10 trillion investment pledge from, 10 trillion yen investment pledge from the Japanese side. And so that's kind of in the broader context of India trying to boost ties multilaterally along with Japan and more broadly as well.
You mentioned economic security. Why is the relationship between Japan and India so important at this point?
So with the Trump tariffs, with the U.S. imposing huge tariffs on India right now, that's it's 50% at this rate, at the current point. That's the highest in Asia so far. Prime Minister Modi is having to kind of consider his options, and we're seeing a big shift in geopolitics here in terms of not necessarily the unthinkable, but relations between China and India weren't that great previously either. But this is now, with relations between the US and India not looking great, there's been a shift, and possibly Modi kind of visiting Beijing and warming ties there. Japan, on the one hand, is also in a similar situation. The Trump tariffs haven't been great for Japan either. So there's this mutual kind of common understanding that there needs to be stronger ties, just multilaterally, not just bilaterally as well.
So stronger trading ties potentially, but what about on the defense or the security front? Are you expecting more signs of cooperation between India and Japan?
Yeah, Japan and India have had strong defense ties originally. Japan has been looking to export some defense equipment to India for some time. We may see some progress on those talks. Also, there has been a 2008 declaration that reports say that Modi and Ishiba are looking to upgrade. So that speaks to the kind of not just the economic ties that are strengthening between Japan and India, but also the defense ties as well. Another point of interest that people would be looking out for is any mention of the Quad, which is the sort of the framework between Australia, the US, India and Japan. The main purpose of the Quad when it came about, nobody said this explicitly, but the understanding was that it's sort of meant to form as a bulwark or a block against China. But then, as I mentioned previously, with India kind of exploring its options, with ties warming with China, with the relationship with the US kind of not what it was before, there'll be interest in any mention of the Quad, whether there will be a Quad summit later this year, what the will on the India side is in terms of what to expect from the Quad framework as well. So that's also a big point of interest.
Sakura, thanks so much for running us through all that. Bloomberg Japan politics and economics reporter Sakura Murakami. For more on these shifting sands in geopolitics, let's bring in Ulrike Schaede, Professor of Japanese Business at the University of California, San Diego. Professor, good to see you. We have, these alliances, some of them drawing closer, some of them being readjusted as the U.S. takes a step back in global leadership. For India and Japan, one of the key things on Modi's visit would be, enhancing the free and open Indo-Pacific. What are you expecting in terms of the framework?
Yeah, so the FOIP, right, the Free Open Indo-Pacific framework actually goes back all the way to the late Prime Minister Abe. And this is the moment to make it stronger because India is looking for new coalitions. And one of the things that's going to happen here is they're signing or have already signed maybe an agreement that Japan will transfer its legacy semiconductor production business to India, which will reduce India's dependence on China and strengthen India's dependence on Japan. So one of the things that's so interesting to watch out here for is that there are no stable coalitions. Right? So everybody is trying to find new friends, new coalitions, reduce dependencies on one, broaden the network so that there are more players in the field, in the pool, so to speak. And India and Japan have this thing going back to 2008. So that's very stabilizing to both of them, and they will be able to build on this and find large markets for their products and their technologies.
As you're alluding to, it's really about this economic pragmatism. As Japan looks to India, we know how India has also been in the crosshairs of the U.S. because of its purchases of Russian crude. How do you think all this is going to be received in Washington?
I think the American trade negotiators are thinking this one by one. And so they have a deal with Japan, and they have a deal with India, and they have a deal. And what we're beginning to realize now is that, as I just mentioned, the coalitions are shifting. They're not necessarily stable, but the rest of the world is trying to build up its own network to create a buffer against these uncertainties, right? And so if Japan and India can be closer, and India and China can be, and so forth and so on, then maybe we in Asia are no longer so dependent on the shifting positions that come out of the United States.
The cornerstone of Japan's diplomacy has been the alliance with the United States, and yet because of trade issues, even its top trade negotiator canceling his recent trip to Washington, D.C. How much trickier has it gotten for this administration in Japan to deal with global geopolitics and its position in the world?
Yeah, so this is obviously very complicated. It's not entirely clear why Akazawa-san canceled his trip. The easiest and maybe the closest to the truth is that there are still issues to be figured out in terms of, is there a written document, and if there's a written document, what's in it. And so the official reason why Akazawa-san is not going or has not gone today is that they have to kind of cross the T's and dot the I's and that sort of thing. So that's the most sort of basic explanations we can get, and I think there's some truth to that. It's also the case that this whole deal that's tied to the tariffs, which is a joint investment fund or a Japanese investment fund that benefits the United States, that deal it's not clear how that could even work, because Japan doesn't have a sovereign wealth fund. How would that money go? Where would it sit? Who would use it? There's an article in the Japanese press yesterday that Masayoshi Son, who is a close business affiliate with Commerce Secretary Lutnick, is sort of involved in these negotiations. So I don't know whether that's a conspiracy theory or whether that's true, but the stories are flying left and right. And within that settlement, or within that setting, it's very difficult for Japan to do anything. And so my guess is that Akazawa-san is following the traditional Japanese advice when you do a business deal. If you're in a hurry, run around the block. That is, patience is important, and so don't sign anything in a hurry. Make sure you know exactly what you're signing, and so I think they're just making sure that this is exactly what they want, and I'm not sure whether the two sides can come together on that, frankly.
And yet, when it comes to patience from businesses, that might not be the case. The agreed lower tariffs haven't even been implemented yet. How big is the pain for Japanese corporates?
Yeah, excellent question. It's painful. It's painful for everybody right now, right? So even General Motors has just announced that they're taking $1 billion off their bottom line because of this. The Japanese car makers so far have eaten the tariffs, but they've stopped doing so. And so they're increasing prices in the US. It's very painful. This really is painful. But I think the calculation that the Japanese government has to make is it $550 billion painful, right? So is Japan better off just doing the tariffs, or is it better off doing this investment deal? And so far, the calculation for Japan has been tariffs are super painful. So currently, they're still stacked, right? And so what Japan wants to do is they want to get that stack out, and it's not clear that the U.S. is willing to do that.
Ulrike Schaede, professor of Japanese business at the University of California, San Diego. Great to have you with us. Now, the IMF's first deputy managing director, Gopinath, is warning against complacency over global debt levels, citing fragility in bond markets. In an interview with Bloomberg, she reflected on her 7 years as the IMF's #2 official and how the world has changed during that time as she prepares to step down this week.
Pretty much, I think everything has changed. I started at the IMF in 2019, and that feels like that was the calm before the storm. And you had the pandemic, you had war in Ukraine, and now geoeconomic fragmentation. I think the global economic order is transforming in ways we haven't seen in decades, and it's still highly unclear where the global economy will settle. I think a second big difference between 2019 and now is on the fiscal front. Debt levels are incredibly high. They are ever increasing. And while in the past you might have said, so what, markets will take it, that's not the case anymore. Even in advanced economies, you see that in France, the UK, and also in terms of long yields in the US. And I say the third big change is on technology. AI over the last few years has certainly caught the imagination of everybody, huge promise, but also huge risks.
How has the IMF's role changed during this period, given that it was set up under a very different infrastructure at a time when a lot of people are saying we're now in the post-Bretton Woods era?
The IMF has great experience dealing with turbulence. You know, there was a period when you had the end of Bretton Woods going off the fixed exchange rate to the dollar and the dollar to gold. That change happened, and the IMF adapted. And we are obviously now in a world with big shifts in terms of how countries work with each other. The IMF has always functioned as trying to do the art of the possible, which is do the best you can given the constraints, and done it very successfully. So if ever there was a time for this institution, it's super important now. It has the ability to bring different countries together around the table, good discussions to happen in the economy, on the outlook. Again, a very vital institution for the world.
Do you see a risk that it doesn't survive, though, at a time when funding is really in question with a lot of major economies? We've seen China go it alone. There have been questions about the United States.
Firstly, the IMF's funding structure doesn't rely on any budgetary support from any country. So it's in a very strong place because of that. And everything we've seen so far points to all the members wanting the IMF to continue functioning as it has. We work very closely with the U.S. administration. That engagement is going extremely well, but also the other 190 member countries that we have. So as of now, lots of support. Of course, the environment has changed, and the IMF is going to adapt to it in this new geopolitical environment that we have. But it has a lot of experience dealing with these kinds of events.
IMF First Deputy Managing Director Gita Gopinath speaking with our colleague Lisa Abramowitz. We have more ahead on the Asia trade. This is Bloomberg.
And we're counting down to the China market open. It is a big day in terms of earnings. Companies with combined more than $3 trillion market cap are reporting. So really big day in terms of this earnings season. And this is coming at the time when the share rally in Hong Kong has been finely poised. If you take a look at this chart, it shows you how the China Enterprises Index is actually nudging towards, already hitting the 100-day moving average. And it's also really interesting how just a day ago we actually saw record southbound selling and mainlanders preferring their own market. Now, these big Chinese banks are due to report later today as well. They include ICBC, Agbank, China Construction Bank, and Bloomberg Intelligence thinks CCB faces more pressure than other lenders amid muted mortgage demand and declining consumption loan quality. The world's biggest EV maker, BYD, also reporting later, but not forgetting Alibaba. It's set to report its first quarter results, and earnings from its peers suggest that intense competition in the food delivery sector is taking a toll. For more, Bloomberg's tech correspondent Annabelle Drollers joins us from Hong Kong. So, Belle, what are investors watching from the results, especially after what we saw from Meituan this week?
Yeah, that's it. I mean, it's really that big focus on the competition we see in the food delivery space, because it's been an interesting ride for Alibaba. I mean, if you look back over the last 12 months, the stock is still up around 45%. But when we've had that upward pressure on the price, it's really been a reflection of that optimism and the commitment that Alibaba has to its AI business. But we do see a lot of question marks really over competition in the e-commerce space and food delivery in particular. So competition, as you said, Meituan, JD.com, it's very intense, and the expectation actually from here is that it's only going to be getting worse. So the unit in particular to watch for these numbers is the local services group at Alibaba. That includes platforms like Elinor, also AMAP as well, but it is likely to post a loss in the June quarter of around $460 million. That would actually be the biggest one as well on a 3-month basis going back to 2023, again, according to our survey here. But perhaps more important than what's backward-looking is also the guidance that we get from the company as well. What's their commitment to defending their territory, expanding their territory in the food delivery business over the coming months or even longer than that? JP Morgan actually says that Alibaba, out of the three, does have the strongest commitment. They've got the most resources as well to do just that. So they are expending a lot more spending in this space, again, over the coming year.
And yet when it comes to that pain among Alibaba's food delivery rivals, is that necessarily a bad omen?
Yeah, we were talking about that this week as well, because Meituan, for instance, had their numbers out and they guided for what could be a loss in the second half. Very bad numbers as well, the latest reading. And there was that sort of question, if Meituan is feeling the pain, if JD is feeling the pain, is that actually something that can benefit Alibaba if they're managing to profit from that? So the big question, of course, is how they're faring against their competitors. What will be clear, though, what will come out of the earnings perhaps, is just how much they're having to spend on this effort, because that is having a bearing when it comes to price targets on the top, or on the stock rather. We've seen downgrades for the likes of JD, for instance, in the last 3 months, down around 22% rather. Meituan, the price target on average has fallen around 26%. Alibaba doing better, but still down 11%. JP Morgan is saying that the street will cut its earnings guidance or consensus for the company after the results today, given that it's burning so much cash to defend that market share, and that is expected to continue.
Annabelle Drollers there with what to expect from Alibaba. We're getting breaking news out of Japan. We have the industrial production numbers, a contraction of 1.6%. The preliminary numbers for July from a month earlier. And this is a bigger contraction than was expected, also falling into contractionary territory from expansion in the previous month. Year-on-year basis, a contraction of 0.9% for July, really showing the drag when it comes to automobile output dropping because of those 25% tariffs on the sector. And when it comes to retail sales, year-on-year is also a very small growth of 0.3%, which is a big slowdown from the previous month when it logged more than 2% growth for the month of June. When it comes to the month-on-month number for retail sales, is also a contraction of 1.6%, a bigger contraction than economists had expected. Of course, not surprising given that we continue to see inflationary pressures here in Japan. We saw Tokyo inflation just minutes ago also surpassing that 2% level. This is Bloomberg.
And here are some of the stocks we'll be keeping watch on when trade opens in Australia, Korea and Japan shortly. Two big ones in Australia. Virgin Australia stocks, that will be in focus after the carrier released its first full-year earnings report since relisting on the Australian Stock Exchange. And this follows on from a 5-year absence. Net income fell 12% from the previous year to $318.3 million, while revenue and other income climbed 3%. The other one we're watching, Lynas Rare Earths, after it completed placement of 56.6 million shares that's worth about $488 million. The company will use these funds to streamline existing operations and expand Malaysian processing plants. Shery.
And we'll be watching Japanese assets at the open as we digest July industrial output contracting 1.6% month-on-month. Surprise to the downside. Same for retail sales, a contraction of the same amount month-on-month. On the other hand, we are seeing some more solid numbers when it comes to the job sector. The jobless rate falling to 2.3%, perhaps pointing toward more wage inflation. Tokyo CPI also meeting forecasts. So we'll be watching whether we could see more curve steepening in the JGB space, because we saw the 2-year JGB auction drawing the weakest demand in 16 years as well, and signs of hawkishness coming from the BOJ board. The market opens in Tokyo, Sydney and Seoul are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we digest data early here in the Asian session, but also over in the U.S. April, we got the second quarter GDP numbers accelerating slightly faster than initial estimates. And of course, all of this ahead of the Fed's preferred inflation gauge coming out on Friday.
Yeah, and in terms of data, you were just breaking as well what we got out of Japan. Those Tokyo CPI numbers, does it back the case for a BOJ rate hike, right, Shery?
Yeah, coming in line with estimates, still above that 2% level. But of course, it's also the labor market that we're following, a little bit more strength. We saw the jobless rate falling. On the other hand, we also got data a few minutes after that showed industrial production, not to mention retail sales, surprising to the downside and contracting month-on-month. So will we see that curve steepening trend that we've seen here in Japan, especially with more hawkishness perhaps coming from the Bank of Japan? We heard from one board member that was seen as more dovish now talk about continuing to lift rates. The Nikkei stock market right now coming in a downside of 0.3% early in the session as we continue to watch the Japanese yen, which strengthened in the overnight session. And we're around that 146 level against the US dollar. And of course, as I mentioned, all of the implications for the JGB space as we're still really digesting the fact that we got the 2-year JGB auction seeing the weakest demand in 16 years. Take a look at how Korea is also coming online because we had the Kospi and the Korean won supported. The Bank of Korea in the previous session deciding to hold rates steady, but the statement and also Governor Lee Chang-yong's press are seen as less dovish than expected. The Kospi now gaining 0.4% as the Korean won holds steady at that 13.85 level against the greenback Avro.
Yeah, and Shery, you talk about this curve steepening in Japan. We're also seeing that playing out in the U.S., but for different reasons. In Japan, it's about the BOJ rate hiking, but in the U.S., it is about the expectations of those Fed cuts. And even though we saw the gains in the short end of the curve taking a bit of a breather overnight, we are seeing a bit of a slide on the 2 years at the moment. 10-year holding at the yield 4.2 level. And of course, we also keeping tabs on Brent crude, which rose overnight. We did hear from German officials talking about how a meeting between Putin and Zelensky seems unlikely. What is that going to mean for the chances of a peace agreement between Ukraine and Russia? And what is this going to mean for Russian supplies of energy into the global market? Looking at the ASX 200 as well, sitting a bit softer. And this, of course, following on from, as you alluded to, the U.S. stocks rising to fresh highs overnight. One stock we're going to be watching, Lynas Rare Earths. We'll unpack that a little bit later. That is dropping about 9% in the early goings. Aussie to the U.S. dollar holding at 65 cents. Now let's bring in Raj Singh, multi-asset portfolio manager at Principal Asset Management, for some analysis. So Raj, we did see a really solid performance on Wall Street in terms of stocks. Are you looking ahead to the inflation data that's coming out later as something that could potentially derail this?
Yeah, first of all, good morning. I would say that the inflation data, the today's PC reports, definitely we are not looking for big surprises because we know from the PPI and CPI that how it's going to look like. So in terms of what it means, like for the Fed policy, I think the September base cases 25 basis point cut, it's fully priced into the market. So what will be more important in our opinion is how the next Friday's labor market report looks like and what will be the CPI reading for the August number, whether we see further signs of tariff inflation creeping into that number. So that's what we'll be watching for. Any big downside surprises on the payroll side especially can boost the case for a jumbo cut. Otherwise, I think 25 basis point is the base case. However, what markets will be looking for will be basically beyond this September meeting, how the Fed policy path folds out. People are looking for 125 basis point of cut in 1 year. So whether the time period really holds up is the big question. And the second, beyond that, I would say the policy aspect, market is really paying a lot of attention to the Fed independence aspects, and any erosion of the Fed independence can spook the markets.
I was just about to ask you, how might the threat to Fed independence, or the perceived threat, actually play out in markets towards the end of the year and going into next year, and might that muddy the waters?
Yeah, so I would say it's a two-edged sword. Definitely, as the composition of the Fed keeps changing and the tilt goes towards the dovish side of the things, it will be good for the risk assets. So in general, I would say the risk assets are still looking in a pretty good spot here, despite some of the, I would say, fragility showing up in the economic data, especially on the labor side. But where it can have bigger impact will be definitely on the bond side, and that's where right now the action is happening. The U.S. curve is steepening, but bear in mind the curve is steepening everywhere. So definitely it's a factor. Market is also hooked up, but in a long term, I'm not sure how much impact it's going to have on the Fed policy, because ultimately the Fed is going to be driven by the data, which is labor and inflation, and that's going to drive the policy action to large extent. And despite all the noise we see in the markets, it's highly underappreciated that when you look at the developed market curve, US 30-year is still on a relative relative basis, is the best performing curve out there in the developed market. The German bonds are up like 30, close to 60 basis point. Your JGBs 30 are up close to 90 basis point. In fact, we have seen that movement in China as well. So it's a global phenomenon of that steepening of the curve, but definitely erosion of the faith in the Fed policy can have longer term repercussions, and we'll see how that plays out in the market. But it would be mainly a bond market story at the beginning.
Over in China, also a story of tech, because we do have Alibaba, of course, results out today as well. What are we expecting in terms of some opportunities that we could see in that market?
Yeah, so China is a very interesting market, and I would say we have been highlighting it for some time. What you see in China is basically that there are a lot of household savings. So the households are sitting close to, let's say, 19, 20 trillion US dollar, kind of like the deposits. So the household savings are in excess in China, especially after COVID, that savings have built up. At the same time, the policymakers are definitely trying to guide that long-term institutional capital into the market. And the reason for that is that it can act as a catalyst for the economy because of the wealth effect. So in China, I think you may keep seeing this bifurcation between the fundamentals and the market, where the market may keep driven by the liquidity aspect, because the deposit base, the excess savings are quite huge. The bond yields are low, so that rotation from equities into equities from fixed income will be there. And I think that the opportunities lie structurally in the high dividend stocks and some of these tech stocks. So that bubble of tech and high dividend still makes sense to us, and we have to see what happens to this price war on the overcapacity side. We see, and market will be definitely parsing through the earnings of some of these tech giants, like how that competition is looking and what it means for the deflation story at the macro side, and the second for the corporate earnings story. And I would say that the earnings so far are a little bit underwhelming, and some of the market rally is driven by the valuation aspects because it's a liquidity-driven rally. But I think tech and dividend stocks are definitely going to be the story in China.
And just before we let you go, credit spreads grinding lower across the world. Where are you seeing the opportunities?
Yeah, I think the credit spreads are quite tight globally, and the credit curves are quite flat. So I think we still like the carry. So definitely at the short end of the curve, we are shifting more from the credit side. And at the longer end of the curve, we are switching the duration to more to the treasury duration, preparing for some of the, maybe we say the air pocket, which we may see given the uncertainty in the macro data we are expecting on the back of these tariffs and other policies we are seeing from the U.S. administration, and also some of the front loading which has played out so far. Probably it will give back in next 3 to 6 months.
Raj, great to have you. Thanks so much for your insights. Raj Singh is multi-asset portfolio manager at Principal Asset Management. Now, as promised, let's take a look at how Lynas Rare Earths is faring in trade. We're seeing it sliding after trading resumed, and this is following on from it raising the equities, and that is to the tune of about 750 million Aussie dollars. So shares really falling here, although it is paring some of the earlier declines of as much as 9%. We'll have more ahead on the Asia trade. This is Bloomberg. Chinese President Xi Jinping's closest international allies, including the leaders of Russia and India, are gathering in Tianjin this weekend for China's biggest diplomatic event of the year. The Shanghai Cooperation Organization Leaders Summit will be followed next week by a rare military parade in Beijing. Our chief North Asia correspondent, Stephen Angle, joins us from the Chinese capital. So, Steve, what are we watching out for from the SCO, and what are we watching out for from when these allies meet?
Well, obviously, the SCO that China helped set up, obviously, with founding members back in 2001, has tried to be a security counterweight to the United States. Obviously, Vladimir Putin will be here, and we'll be likely watching to see how and where Xi Jinping and Vladimir Putin add to and build upon their no-limits partnership. But also, of course, in addition to all the Central Asian countries like Uzbekistan, Tajikistan, Kazakhstan, and others, we're also going to have India participate here, and the Prime Minister Modi will be here at a time of very sensitive geopolitical tension between the United States and India, and at a time of rapprochement between Beijing and New Delhi. So that's what I'm going to be watching much more closely than perhaps any sort of further engagement between Putin and Xi. It's the Xi-Modi dynamic I'm watching most closely. It is Modi's first visit to China in 7 years. And again, it comes at a time when the Trump administration has been blasting the Indians for, as Scott Bessent says, the U.S. Treasury Secretary, profiteering on buying cheap Russian oil on the global market, refining it and selling it onwards. That's why the Trump administration, much to the surprise of New Delhi, slapped a 50%, 25% premium tariff on Indian goods because of India buying Russian oil. So what that means is China has taken the opportunity to sort of test the waters and see if India and New Delhi is willing to bridge their differences after decades of differences and even a border skirmish back in 2020, 5 years ago. They are repairing their relationship. Modi's going to be here. So we want to see at the end of the SCO on Monday what kind of joint statement will be put out and whether all 10 members and also the 26 total participants that are going to be here will be, dare I say, full-throatedly supporting any kind of harsh criticism of the United States and its protectionist tariff regimes.
Steve, how significant is this gathering in President Xi's goal to lead an alternative global geopolitical order?
Well, if you look at the 24-year history of it, it's had a sketchy past as far as getting all those members, as I just mentioned, on board with sharply worded statements. So this might be the year that Xi Jinping, as the host, can get them all on board because, again, there have been different interests among different nations and not necessarily wanting to go against their agreements and their alliances with the United States. Things are a little bit different right now. Donald Trump's administration has levied many nations, if not most nations of the world, with tariffs and striking more of an antagonistic approach to relations. So if China can get India on board full throttle, and obviously Russia's on board, but if you can get also the periphery nations, Turkey, Erdogan, the president, is going to be here. They're not necessarily joining the SCO, but they're going to be a participant. Saudi Arabia, Mongolia, Malaysia, Indonesia, Iran, they're all here. And this is a bloc of nations that comprises not only half of the world's population, but a lot of the energy assets. Let me look at here. 25% of oil reserves, 50% of gas, 35% of coal, 50% of uranium. As I said, nearly half of the world's population. This will likely be the biggest SCO ever held, and we'll just have to wait to see at the end of it whether it will also have the most powerful, forceful joint statement.
Our Chief North Asia correspondent Stephen Engel there joining us from Beijing. We're also following the latest on the tariff negotiations with the Trump administration. The European Union has adopted draft regulations to remove all tariffs on U.S. industrial goods. It comes after the bloc struck a political trade agreement with Washington last month. Bloomberg editor Jill Deasy joins us from Hong Kong. Jill, does this mean that we could see the U.S. also lifting tariffs on the European Union?
Well, ultimately, what this is this kind of arrangement is supposed to be done, if this is ultimately approved here, is that this was set up by Donald Trump as a condition for the EU to get tariffs on auto parts, automobiles lowered from 27.5% to 15%. So essentially, this is a push, pressure by the Trump administration to try to bring the EU to bring more concessions to the table so that they can make something like this happen. Then the idea would be that those retroactive tariffs, that lowering on European cars and auto parts would happen, would retroactive to August 1st. All that being said, though, I will point out that Donald Trump, has continued to make threats involving other types of levies and such. One thing that is really that Trump is fixated on within the past few months has been this idea of digital services taxes in places like the European Union. I'd also point out the UK has a similar, those are, services taxes that he says really unfairly target big American tech companies like Apple and such. He was actually fairly successful, Trump was, in earlier this summer convincing Canada to drop a digital services tax that they were considering. Does he bring that up with the EU? I think that, we'll have to see. But I think just kind of underscores the fact that while the EU is making some concessions in some areas, I'm not sure that the overall idea of potential tariff threats goes away.
Jill, we were just hearing there from Steve about Modi heading to Tianjin, but he's also going to be in Japan. What are we expecting from that in terms of potential investment commitments from Japan into India?
That's right. So Modi going to Japan, he's there for his stopover. I think, at this stage, he's expected to secure some investment pledges worth somewhere in the neighborhood of about the equivalent of $68 billion from this two-day trip to the country. So the idea is that, what Modi's really targeting here is trying to bolster the Indian economy as it deals with these UF tariffs. Remember, those 50% tariffs that the United States has introduced, highest really among a lot of other Asian nations. So what Modi is trying to do here is essentially try to figure out other ways to shore up his economy. Strengthening those types of investment ties with Japan is maybe one way that he's able to do that.
Jill, thank you so much. Bloomberg's Jill Deese is for us. Now let's take a look at how Europe futures are faring as well. We did see it a bit softer overnight, although automakers bucked the trend. This was not really because of the tariff developments, more to do with car sales data. We're seeing Euro Stoxx 50 futures pointing to a slight upside. Euro dollar looking a bit softer towards the 116 level. Now, the IMF's first Deputy Managing Director Gopinath is warning against complacency over global debt levels, citing fragility in bond markets. In an interview with Bloomberg, she reflected on her 7 years as the IMF's #2 official and how the world has changed during that time as she prepares to step down this week.
Pretty much, I think everything has changed. I started at the IMF in 2019. And that feels like that was the calm before the storm. And you had the pandemic, you had war in Ukraine, and now geoeconomic fragmentation. I think the global economic order is transforming in ways we haven't seen in decades, and it's still highly unclear where the global economy will settle. I think a second big difference between 2019 and now is on the fiscal front. Debt levels are incredibly high. They are ever increasing. And while in the past you might have said, so what, markets will take it, that's not the case anymore. Even in advanced economies, you see that in France, the UK, and also in terms of long yields in the US. And I say the third big change is on technology. AI, over the last few years, has certainly caught the imagination of everybody, huge promise, but also huge risks.
How has the IMF's role changed during this period, given that it was set up under a very different infrastructure at a time when a lot of people are saying, we're now in the post-Bretton Woods era?
The IMF has great experience dealing with turbulence. There was a period when you had the end of Bretton Woods going off the fixed exchange rate to the dollar and the dollar to gold. That change happened and the IMF adapted. And we are obviously now in a world with big shifts in terms of how countries work with each other. The IMF has always functioned as trying to do the art of the possible, which is do the best you can given the constraints, and done it very successfully. So if ever there was a time for this institution It's super important now. It has the ability to bring different countries together around the table, good discussions to happen in the economy, on the outlook. Again, a very vital institution for the world.
Do you see a risk that it doesn't survive, though, at a time when funding is really in question with a lot of major economies? We've seen China go it alone. There have been questions about the United States.
Firstly, the IMF's funding structure doesn't rely on any budgetary support from any country. So it's in a very strong place because of that. And everything we've seen so far points to all the members wanting the IMF to continue functioning as it has. We work very closely with the U.S. administration. That engagement is going extremely well, but also the other 190 member countries that we have. So as of now, lots of support. Of course, the environment has changed, and the IMF is going to adapt to it in this new geopolitical environment that we have. But it has a lot of experience dealing with these kinds of events.
IMF First Deputy Managing Director Gita Gopinath speaking with our colleague Lisa Abramowitz. We have more ahead on the Asia trade. This is Bloomberg.
Some stories we're following from the corporate front. Warren Buffett's Berkshire Hathaway has raised its stakes in Mitsubishi and Mitsui, delivering a vote of confidence in the Japanese trading houses. A unit of the U.S. investor increased its holding in Mitsubishi to 10.2% on a voting rights basis from 9.7% in March. Mitsui also said Buffett's company lifted its stake in the trading house. Temasek will split up its $338 billion portfolio in April as part of a major overhaul to sharpen its focus and improve returns. The move, which were first reported by Bloomberg, will create units focused on investments in global companies, Singapore-based firms, and managing capital allocation. Temasek International's deputy CEO will also be appointed company co-CEO starting in October. Michael Saylor's Bitcoin strategy is facing market backlash. Shares of his firm Strategy are down 15% this month, erasing much of the premium over its Bitcoin holdings. Investor confidence has been shaken by weak demand for a new preferred share sale and a return to common stock issuance, despite earlier pledges to limit dilution. Analysts warn Saylor's model of using corporate balance sheets to buy Bitcoin may now be at risk.
And big moves with Japanese advertising firm Dentsu. It's continuing to restructure overseas operations and considering all options to improve corporate value, seeing its best day in more than 3 weeks. We're also following chip stocks in South Korea after Nvidia pared back some of those losses after an uninspiring forecast. Several analysts raised their price targets, Samsung clawing back some of those losses after the Nvidia fall. We also in late hours had Dell giving a bullish outlook. You can see SK Hynix still under pressure, 0.2%. More ahead on the Asia trade. This is Bloomberg. We're looking ahead to Alibaba's earnings. We are watching cloud computing profits that could be overshadowed by the cost of subsidies and discounts in the food delivery sector, especially if we take cues from earnings from Alibaba's peers, really showing that hyper competition in the sector taking a toll. You can see in that chart the average price target given to Meituan shares by analysts has fallen since the start of the second quarter. Same thing for JD.com's and Alibaba's average price targets as well. Goldman Sachs seeing that Meituan accounts for about 47% of China's food delivery market by volume. Alibaba had a market share of around 43%. And let's delve into what we can expect from Alibaba's first quarter results later with Elinor Leung, head of Asia Telecom and Internet Research at CLSA. Elinor, great to have you with us. What will you be watching, the key metrics for Alibaba to see whether the last quarter was a success?
Thanks. We think the Alibaba June quarter result is going to be a mixed bag. There because of the intense competition in the on-demand retail space. Its e-commerce revenue will likely sustain a steady high single-digit revenue growth because benefiting from the trade subsidy program and take rate expansion, given the growing adoption of its omni-platform marketing solution, 全站退. However, its e-commerce profit could drop by 15% year-on-year, given the hefty subsidies in the food delivery as well as instant shopping segment. The investment could be as high as 10 billion RMB in the quarter. But their cloud business will likely surprise on the upside. We expect the revenue growth to further accelerate to over 20% year-on-year with a steady 8 to 9% margin, given the strong AI cloud demand. China models has substantially narrowed its performance gap with the US peers, and most of the model is open source right now, and the inferencing cost has dropped by more than 97%. This has sparked a widespread AI application creation, and cloud benefit most because the corporate will have to rely on the cloud service provider more on the technology support, as from the fine-tuning of the model to the AI application creation. And Alibaba will capture most of these demand as an industry leaders. They have the most comprehensive.
So you mentioned how the e-commerce sector should be steady, but we are now seeing the Trump administration ending the de minimis exemption. Will this have implications for Alibaba, and when could we see that filter through?
I think the impact may not be that big for Alibaba because most of their business is the China e-commerce business. Although the consumption is still weak, but it's stabilizing, and the government is putting the trade subsidy program, which benefiting the e-commerce platforms there. That's why we expect the top line growth for Alibaba e-commerce China's business is still going to be steady. GMV growth probably 4 to 5%, but because they have the take rate expansion, thanks to the AI enhancement, that's why the overall e-commerce revenue can grow 8 to 9% for Alibaba. For their international business, it's still growing quite nicely, about 20%, over 20% year-on-year. They have not much presence in the US. They're mostly selling in other part of the world, unlike Temu. So we think the tariff impact on Baba will be relatively small.
Domestically, Elinor, we know how Chinese authorities have been drafting out new rules that could affect the way these internet platforms price. Is that going to affect the way, their price setting ability and in turn their outlook?
I'm not aware of the rules in terms of how they set the price. If you look at China, the charging model is quite different compared to the US. If you look at Amazon, they charge 15% commission across the board for the small company to the big company. And the commission differences is just by category. In China, on the other hand, the commission is relatively a smaller part of the overall business. I think at most it accounts for 1/3 of the revenue of the platform. And that commission is not going to change. It's going to be stable because it makes it cheaper for the SME to sell product on the platform. Large majority of the revenue or the take rate in China is come from advertising model. And as you know, like search, that advertising rate depends on supply and demand. So it's very difficult to regulate on that front. We still see there's a lot of upside for the take rate, advertising take rate in China because of the AI tools. They are launching more AI tools to empower the merchants. Like now, Baba is introducing like image to video AI tools where the merchant can upload one or multiple products up to the website, to the tour platform, and it can be automatically convert the picture into video within 20 seconds. They already create 1.5 million models since they launched the AI tool, and all these can increase the product exposure as well, increase the conversion rate of the product, and that will further help them to increase their take rate on the platform.
So what is your outlook on the share price for Baba?
I think the e-commerce downside risk has factored in the share price because the company already saying that they're going to spend 50 billion RMB in terms of the on-demand retails. We expect it could be roughly 10 billion in June quarter, 20 billion in the September quarter, 10 billion in the December quarter, and then 10 billion in the March quarter. That's our estimates there. I think that already been factored in. I doubt that they're going to spend much more than this one because this is pretty intense, which cost Meituan is barely making money already. So we think the upside surprises could come from their cloud. We think China Cloud will continue to surprise on the upside because of the so affordable models as well as the inferencing costs. We could see the AI application creation in China is a lot faster in China, and they will have to rely on cloud more for the technology support because no one has AI talent in the corporates. So that will help the cloud in China to further accelerate the growth.
Elinor, thank you so much. Elinor Leung is head of Asia Telecom and Internet Research at CLSA. Now, we're also going to be watching for BYD earnings. It's expected to report robust profit for the first half of the year after heavy discounts across some of its models boosted sales. Bloomberg Asia transport reporter Linda Liu joins us from Hong Kong. So, Linda, are we likely to see, potentially these discounts continuing to pay off for BYD? At what point does this prompt a sort of pivot in the EV space?
Yeah, it's a really interesting question for BYD right now. As we've seen, the Chinese government has launched this anti-involution campaign, essentially trying to stamp out unhealthy competition across a number of sectors. And one of those is the EV sector. So BYD might not be able to use so much discounting going forward. And that leaves them with the question of whether they can keep the sales momentum going if they're not able to slash prices on their cars anymore. Going into the second half of the year, the competition is going to ramp up still. BYD's rivals are coming up with newer models as well. Everybody is trying to achieve their annual sales targets in this remaining few months in the year. So that's something that we're going to monitor really closely.
Linda, can their overseas sales help?
Yes, BYD has put a lot of their resources into expanding globally. Their overseas growth has grown a lot this year. They've been expanding into new markets. They're ramping up sales. You're seeing some pretty key metrics that they've achieved. For example, in the UK, they've recently outsold Tesla. So that really shows their overseas ambitions because these markets are going to bring better margins for BYD than compared in China, where there's a price war going on. So BYD is probably hoping that their overseas sales will offset softness in the domestic market. But again, other Chinese automakers are also having similar strategies to BYD. A lot of them are also ramping up global expansion. So BYD will have to really come up with something that's going to set it apart to international buyers than compared to some of its peers.
What about its Mexico exposure? Because Mexico actually, it came out with this tariff plan earlier in the week because of China exports to kind of get things in line with what the U.S. is demanding. Is that a strong headwind, you think, for BYD's business?
That brings us to a key challenge for BYD as well as other Chinese EV makers, is that as they ramp up their sales globally, that might be met with geopolitical tensions and trade barriers. As some of these countries, either they try to protect their domestic industries, or like in the case of Mexico, where they're trying to strike a deal with the US and has come up with these kind of tariffs against Chinese imported goods. So Mexico is China's largest export destination for autos. If the tariffs go ahead, that could be a significant impact to Chinese exports. in terms of cars. We're going to have to see. But, you know, for some of these brands such as BYD, their models are very good value. So it might be a case of customers might still keep buying these cars because even with the tariffs added in place, their pricing will still make sense. But that's something we're going to have to see when and if the tariffs come into effect.
For BYD and some of these other Chinese EV makers, aside from the markets in North America or in Europe, what else are you seeing in terms of the realignment, perhaps in Southeast Asia even?
Yes, so in Southeast Asia, we're already seeing a lot of presence by Chinese EV makers. BYD already has a factory in Thailand. We've also seen another EV brand called XPeng. They recently started production at a plant in Indonesia. So Southeast Asia is a market that's close to home for them, and they also see a lot of growth potential in these areas. So it makes sense for them to ramp up production. And it seems like so far, Southeast Asian countries are more welcoming to the Chinese brands compared to some other markets like the EU or US. I think as long as these Chinese automakers continue to, you know, build good partnerships with local companies, they bring jobs as well as investments into those countries, I think Southeast Asia will be more smooth in terms of geopolitics for these Chinese car makers.
Yeah. Good to get your insights. Bloomberg's China automotive reporter Linda Lu there. And China's Shery automobile has filed for a Hong Kong listing as well. Sources earlier said the move could raise some $1.5 billion, and the listing could take place as early as next month. Hong Kong is seeing the return of billion-dollar deals, with listings in the city already raising $17 billion, putting it on track for its best year since 2021.
And of course, Shery, China is set for its busiest earnings day for the month. And we're having these big Chinese banks also due to report later today, and that includes ICBC, Agbank, China Construction Bank. Bloomberg Intelligence saying CCB faces more pressure than other lenders amid muted mortgage demand and declining consumption loan quality. Plenty more ahead on the Asia trade. This is Bloomberg.
We're watching Japanese assets, especially in the JGB space, after the two-year JGB auction yesterday drew the weakest demand in 16 years. We continue to see expectations that the BOJ could be soon hiking rates. We also got Tokyo inflation sort of coming in line with estimates. We continue to see signs of hawkishness. Usually dovish BOJ board member Junko Nakagawa, for example, reaffirming the bank's commitment to continue lifting its benchmark rate if conditions do allow. We have seen 30-year yields surging to new records this week, and we are headed for next week's scheduled 10-year and 30-year auctions as well. But we'll be focusing really on all of the economic data out this morning, especially with inflation in Tokyo in line with estimates, but still easing sharply in August. We had seen some government utility subsidies making an impact on prices. Still, the inflationary picture well above the Bank of Japan's target. Bloomberg senior editor Brian Fowler joins us now to break down the data, and still above that 2% level, but food wages still continue to be strong.
Yeah, that's exactly right, Shery. So we did see inflation come down, slowed quite a bit in Tokyo, but as you said, that's due to subsidies to offset utility costs. Those are, of course, temporary, and so electricity and natural gas prices came down quite a bit. We also saw cost for water come down 30%. That's not only a temporary subsidy, but it's only in Tokyo. So, of course, that won't be part of the nationwide data. Elsewhere, on the upside, food costs remain really pretty hot. Rice prices rose about 68%, which is a little bit slower than we've seen in recent months, but is obviously still a very sharp increase. And processed food prices were up more than 7%. We saw rising costs for things like coffee and chocolate, things that we all care about on a daily basis. So that's something the BOJ is going to watch, and that gives it a real incentive to consider another rate hike.
We also got data on industrial output, retail sales, weaker than expected. Brian, how is that potentially going to make Ueda a bit more cautious, or is he going to be able to look past this?
Yeah, so Avril, that's a key question. Definitely the data were weaker than we thought. For industrial output, a big factor there was cars. Both output of cars as well as shipments fell, and those were leading declines. That's probably on the tariff effect. But keep in mind that we did get the trade deal at the end of that month of July, and that took away a lot of uncertainty. So we could see a bounce in the months ahead. The estimates for August, for example, show that the ministry now thinks that output will rise 2.8%. That would be the fastest advance in about 18 months, so all is not lost. On the retail sales, that is quite concerning. The wage hikes for this year have mostly been factored into payroll data so far, so we kind of thought we would see a bump in terms of consumption. The retail sales data coming in weaker than thought does spell some sort of trouble on that front, we think. So we'll have to see what Governor Ueda has to say about that next time he speaks.
How difficult is the situation for the governor at a time when, yes, we got a trade deal, but the rates haven't necessarily come down? So when do you start factoring the impact of the rates when they eventually come down?
Yeah, so, I mean, that's what the BOJ is doing right now, intensively, trying to figure out exactly how big the impact will be and when we'll actually start to see these changes take effect. They're still working to get that executive order issued by the Trump White House. But in terms of where the BOJ stands, so we don't think there's going to be a hike in September. September 19th is the next decision. Most expect the BOJ to stand pat. But October is very fluid. Two key things to watch. On October 1st, we'll get the BOJ Tankan survey. If you remember, that survey came out a lot better than expected last time around. So if we continue to see signs of resilience, that would be a green flag for the BOJ. And also, equally important, in October, we'll see the first signs of what expectations are for the next round of wage hikes. Unions will issue their demands. Some companies, we know, because of the tariffs, have sacrificed their profit margins to some extent in order to preserve market share. Does that affect their ability to dole out sharp wage increases? That's a key question, and we will know the answer probably to some extent by October, ahead of that next decision in late October.
Brian Fowler, senior editor here in Tokyo, with the latest on all of the economic data we got out of Japan and, of course, a trajectory for the BOJ. We have more ahead. This is Bloomberg.
Now, among the stocks we're watching in the session today, Virgin Australia, it is down slightly after announcing a 28% jump in full-year profit since relisting on the ASX. Bloomberg's Paul Allen joins us now. Paul, it's been a successful return to public ownership for Virgin. Tell us more about the numbers. How do they look?
Yeah, down today, but at least they're back, right? And back with a profit as well. Underlying net profit, $331 million. It's about $216 million US. And that matched the forecast that was in the IPO prospectus before relisting back in June. Going forward, Virgin Australia does see growing demand for air travel in financial year 2026 in line with GDP forecasts, so it's going to add flights to its schedule and expects to see continuing growth in underlying profit for the coming year. But yeah, it's been a difficult time. The airline delisted in 2020, a casualty of the pandemic and the resulting collapse in air demand as well. Bain Capital purchased it and still holds a 40% stake. Qatar Airways holds a near 23% stake. So even though it relisted in June, ownership remains concentrated with those two big players there. So trading volumes consequently a lot lower than it is for its rival Qantas, and that's something we saw under its previous listing as well.
Yeah, I mean, Paul, Virgin Australia has had a difficult history, right? So what does the path ahead look like?
Well, immediately there's no dividend for shareholders, so they're going to have to be patient on that front. And it is a volatile business as well. So Virgin's trying to carve itself out a niche in the mid-tier. It's leaving the upper-tier passengers to Qantas and the low-cost market to Qantas's offshoot Jetstar as well. But if we look at online fare data, Qantas and Jetstar show the biggest increases. Virgin shows the smallest increase, and this is a metric that a lot of analysts like. And if we take a look at analyst ratings, there's just 7 that follow Virgin. It's got 3 buys, 3 holds and a sell, and that compares to Qantas with 10 buys, 5 holds and 1 sell. So it sort of underscores where Virgin is at in this market. So it's taking a creative approach as well. Later on this year, it's expected to fulfill its desire to allow passengers to bring small pets on board. So that'll give us a point of difference with its competition. It's just got clearance from food standards regulators for that.
Paul Allen there joining us from Sydney, and we'll be watching earnings in the Hong Kong and mainland China session as well. We have the likes of BYD, also banks like ICBC reporting, not to mention, of course, Alibaba. Do watch out for cloud computing profits from Alibaba, although we could see downside pressure from subsidies and discounts in the food delivery sector. When it comes to BYD, is expected to report robust profits for the first half after heavy discounting again across some of its models spurred sales. Do look at what futures trading is doing at the moment, because remember, U.S. stocks rose to fresh record highs with the S&P 500 breaking through that 6,500 level. We continue to see a strong U.S. economy. We are ahead of that July core PCE price index as the Fed's preferred price gauge, so do watch out for that. 850 futures close to the upside. This is Bloomberg.